Want to know a story about investor who turned his life around thanks to the stock market? This British guy was a top performing banking analyst at UBS when he published his book Accounting for Growth. He uncovered misleading accounting practices of big companies and got himself in trouble. His employer at the time has fired him from position of head of research as he described practices of some of UBS clients. It happened in 1992, but shows exactly what type of a man Terry Smith is. He is not afraid to express his opinion and get in an argument. He commented the matter with quite chilling words that he's not the one to start fights, but he finishes them. Once, when he was talking about why he doesn't like activist investors, he didn't hesitate to fire shots at famous activist investor Bill Ackman, and he called him shockingly bad. But how Terry Smith has built his fortune and fame of a great investor? He doesn't come from a wealthy family, quite on the contrary. When he was young, he lived in a house with no toilet inside, and he definitely did not receive any seed capital for his ventures. He climbed the corporate ladder in various organizations, but his true success comes from entrepreneurial ventures. He started his investment fund in 2010, Fundsmith Equity Fund, and achieved some stunning results. Since inception, he managed to compound his investors' wealth at 15.6%, while MSCI World Index has achieved annual return of 11.3%. If you think that those 4 percentage points are not that big of a deal, just look at cumulative results. 527% managed by Fundsmith versus 288.5% of MSCI World Index. Almost double the amount of money. Mm, His performance looks even more stunning when we go back to the annual letter from 2021, when annual return since inception was 18.6%. How did he achieve that? His strategy is actually simple, but definitely not easy. Strategy behind Fundsmith's success relies on three steps. Step one is buy good companies. Fundsmith is very selective with the stocks they invest into. Terry defines a good company as one which receives high returns on capital employed for long periods of time in relation to their cost of capital. He gave this simple analogy that companies are just like us. If you borrow your money at 3% and earn 20% return, you will become wealthier. On the other hand, you will become poorer if you receive lower returns than your interest. Although there are different formulas for calculating costs of capital, such as, for example, WACC, which stands for Weighted Average Cost of Capital, Smith prefers companies that earn such outstanding returns that you do not have to wonder about exact cost of capital because it is sure that ROC is way higher. It reminds me of Ben Graham analogy about fair value of a stock. If you see an obese man, you don't have to know the exact number of pounds he weighs to know he's obese. Similarly, if you are a cashier and an old man with gray hair approaches you to buy a bottle of liquor, you don't need to know his exact age to determine that he's old enough to buy alcohol. But ROC isn't the only indicator that Terry Smith and his team looks into. Because of regression toward the mean, if any specific industry achieves high returns on capital employed, it will attract more and more competition, which in the end will lower the returns. So you need so-called moat, a competitive advantage that will defend the company from the competition. There are different types of moat, such as brands, control of distribution, patents, installed base of equipment, or software that are troublesome to replace. He also looks for businesses that have reinvestment possibilities. Step two is don't overpay. This step brings a lot of controversy as a number of people complain that Fundsmith buys overpriced equities, especially when you judge them on a price to earnings basis. But earnings per share is not the first metric that this British champion of quality looks at. He argues that earnings can be manipulated in a various way, and well, he wrote a book about this topic, so instead he focuses on free cash flow. Free cash flow is money left for the company after their operating and capital expenses. This can't be manipulated as this is literally reconciled to the cash possessed by the company. The point of investment is to receive more money in the future, not to see your paper earnings grow, so he has a point. So instead of focusing on earnings yield, he looks at free cash flow yield. If you know company's free cash flow per share, you can simply divide the price of a stock by FCF per share, and you will receive a percentage yield. He compares this number with what a bond yield should be, and tries to get better yield than on bonds. He also takes inflation into account so he can grow wealth of his clients in real, not just nominal terms. He compares FCF yield of his fund and FCF yield of a broader stock market such as S&P 500. He finished the year 2022 with a FCF yield of 3.2% when S&P 500 was at 3.4%. So the difference is really marginal compared to broader market, and Fundsmith may appear more expensive, but considering how good are the companies he owns, it's not really that expensive, and in my opinion, he does a good job. The last step is do nothing. Fundsmith is a long-term investing fund. Purpose of buying a stock is not to make a quick buck on volatility, but to benefit from long-term growth of companies he's invested in. So when he chooses company right, he'd rather stay invested and doesn't leave his position if thesis remains unchanged. There are actually a few reasons for that. First of all is that by this approach, he can minimize costs of investors by less provisions on purchases and sales. Second of all, he doesn't have to maintain huge number of analysts constantly valuing companies and giving their purchases or sell recommendations. You do your research right and you just observe the fundamentals. This doesn't mean that he never sells. There are a number of companies he has sold, such as Adobe, which he sold pretty much after 1 quarter. It wasn't bought with some short-term thesis. It's just fundamentals can massively change in today's world in relatively short period of time. Adobe Inc. has acquired a company named Figma for a stunning amount of $20 billion, which for Terry Smith was a sign of bad capital allocation. When it comes to one of the best decisions of Terry, we can trace back to his purchase of Microsoft, which has risen to be one of his top holdings, and also it was his 10 bagger stock. You don't really expect a 10 bagger in 12 years while investing in already one of the biggest companies out there. But how did he catch that? I think from financial analysis point of view, it seemed like a screaming buy. Return on tangible equity of Microsoft at the end of first quarter of 2010 was over 60%. Debt to equity ratio was at 8%, so there was almost no debt. With no leverage at all, this company was able to earn 30% net margin. Remember that Warren Buffett has said that net margin of over 20% suggests strong competitive advantage. 30% is simply wonderful. Gross margins stand at 80%, which basically means that you produce something for 20 cents and sell it for $1. Wonderful. When it comes to more qualitative aspects, consider how strong Microsoft Software's position is. Windows had almost 90% share of operating system market. This sits nowadays at 28%, but please consider how much this market has grown with wide adoption of smartphones. Android has almost no share in this market and now is the biggest player. Also consider how crucial to basic operations of almost every business Microsoft tools were. Excel is like one of the most important tools for accountants and finance departments around the world. Maybe some companies use SAP, some of the other use Oracle, but almost everyone working on Windows will be using Excel. World's finances are fueled by Microsoft Excel. Hundreds of thousands of consultants will prepare their presentations in PowerPoint. Millions of students will write their master thesis in Microsoft Word, and so on. Also, Microsoft was focusing on licensing those products, so their revenue was recurring and more predictable. But Windows and their productivity software was not everything. Third segment, which was also profitable, was servers and tools. In order not to dive too deep into it, Azure Cloud is part of this rapidly developing segment. The fourth segment was entertainment, where revenue was also sticky. If you want to play online on your Xbox, you need Xbox Live Gold, which is a subscription model. Also, if you already own Xbox, you buy games for Xbox and you are less likely to suddenly switch to PlayStation and start buying new games. Although nowadays you can buy subscription access to games. And the greatest of all is that he bought it at 10 PE. Most decisions might look easy in retrospect, but keep in mind that this took place in 2010. 1 year after big financial crisis, Microsoft didn't look that great compared to Apple, where PC market was becoming less important and Apple dominated in smartphones and tablets. Another important factor for his investing strategy is not only what to invest to, but what not to invest in. He was a top banking analyst, but he refuses to invest in banking stocks. That is quite a tell. You won't see any commodity stocks or cyclicals where you basically wait for an event to happen. You can see his top position starting from Microsoft, but second one from USA stocks is quite interesting. Philip Morris is a number 1 tobacco company in the world. They possess numerous strong brands such as Marlboro, LM, Chesterfield, IQOS devices, and heated tobacco products. This is more of a defensive consumer company. Stryker, on the other hand, is a company in medical technology, so is IDEX. However, the second one is focused on pet diagnostics. I have noticed that Terry also likes luxury companies. Estee Lauder, LVMH, L'Oreal. Terry appreciates a strong brand when he sees one. So that's all for today. I hope you found value in this video and I hope you have learned something from a truly great growth investor, Terry Smith. Thank you.